Hey everyone, Couch Investor back to another video for you today. So let's talk about PayPal. Reported earnings this week. If you own it or if you own any other fintech stock out there, you've probably got hit and hit hard. They reported earnings, stock went down approximately 20-25% or so, just like Facebook. When Facebook fell, every other company that is remotely related to advertising fell as well. So the same thing happened here. Square, Affirm, Marqeta, SoFi, you name it, all down. Now, just because PayPal reported not so good numbers does not mean that those companies will report bad numbers. Affirm reports next week, I believe Square in 2 weeks or so. So we're going to see what that means. Visa, MasterCard reported great earnings. So there you have it. It's a bit of a mishmash. But let's talk about PayPal, the numbers, and especially what was mentioned during the earnings call, because usually in the earnings call, they tell us a bit more than just the numbers that they just printed out as the earnings release. So first up, they reported earnings per share of $1.11, missing expectation by 1 cent, $1.12, and revenue of $6.92 billion, beating expectations of $6.89 billion. So we're probably saying they just missed earnings per share by 1 cent. Why is the stock down 20+% or so? Well, nowadays, it doesn't really matter whether you beat earnings or miss earnings by a lot or by a little. It's mostly focused on your guidance. But before we move into that part, let's discuss the numbers here. So net revenue grew 13% year over year, and for the full year that grew 17% to $25.4 billion. Non-GAAP operating income basically did not grow this quarter year over year, but for the full year it grew 17% to $6.3 billion, and earnings per share, like we said, 1.11 grew 4% year over year, and then for the full year 4.60 that grew 19%. Now as for other key metrics here, net new active accounts actually decreased 39%. Obviously in 2020 everything got accelerated and pushed forward, so not surprised to see that they haven't grown even more, but 39% decrease is a bit much. But there you have it. We're going to discuss this later on because this will be pretty important in the future. Total payment volume grew 23%, net revenue, we said 13%, and then operating cash flow and free cash flow, still very, very nice, still a very good free cash flow company. Operating cash flow is up 31% and free cash flow is up 38% to $1.6 billion. Now for the full year, the total payment volume grew 31% to $1.25 trillion with a T. Operating cash flow and free cash flow grew 8 and 9% respectively, free cash flow of $5.4 billion. Also, I do want to mention, for those that don't follow PayPal closely, their agreement with eBay is basically over. So right now they're overlapping a year that, well, eBay still had an effect on the company. The second half of the year, that overlapping period will be much easier. They talk a bit more on that in the earnings call. We're going to discuss that in a bit, but first, I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 free stock picks from their popular product, Stock Advisor. Now, Stock Advisor has beat the market by more than 4x. So all you have to do is go to fool.com/couchinvestor to get your free 10 stock picks now. All right, so first up, let's clarify this eBay situation. So they mentioned here during the call that eBay's transition will put an incremental $600 million of pressure on our top line, approximately $400 million in Q1 and $200 million in Q2. The second half of the year, I look forward to being able to stop adjusting for eBay and letting the strength of their core results speak for themselves. He continued by saying that their growth ex eBay has consistently been above 20% and our year-over-2-year growth rates have been remarkably stable. So let's see what happens in the second half of this year. But they're also going to change some metrics with regards to the way that they are reporting. That's the fact that they will be reporting ARPU and monthly active users. So basically they're switching to a reporting style of basically how much revenue they get from each user. Because even though they did add 122 million net new actives over the last 2 years, within that number, there are always a number that are low engaged and have done one transaction or nothing else. Reminds me of Pinterest, added a lot of new users during the pandemic. Some of them are falling off each and every quarter, but it doesn't really matter, doesn't really change the core business because most of them aren't really high valued users. The same thing here. This year they're saying that they're going to do 15 to 20 million. It's probably going to be about 20 million incremental one and done customers that roll off. That does nothing to their revenue. And obviously it does nothing to their revenue since they just do one transaction or basically do nothing, just sign up and do nothing. So having those customers doesn't really make that much sense, which is one of the reasons why their goal of 750 million gets reduced, because right now they're just going to go after those high valued customers. Makes no sense to spend millions and millions of marketing dollars to acquire customers that just do one transaction and that's it. Makes more sense to go after less customers, but high value customers that will make maybe a couple of transactions each and every week. Makes more sense for the business. Now jumping into guidance before we go back to Venmo, etc. So they expect next quarter to just grow 6% or so. Excluding eBay, they expect it to grow approximately 14%. For the full year revenue and earnings guidance, so total payment volume expected to grow between 19 and 22%. Revenue 15 and 17%, excluding eBay 19 and 21%. But they do say that they see growth rates exceeding 20% plus as they exit this year. So they really put a lot of focus on this transition away from eBay. Now it's just a matter of time will tell whether they lied or whether the business is strong and without eBay it will continue to grow over 20% or so. Because if that's the case, then it surely is a good opportunity right now. And as for Venmo, they say here that Venmo had a solid finish to the year and closed out 2021 with more than 0.25, so a quarter of $1 billion of revenue in the fourth quarter, and that's up 80% year over year. They're still at the beginning of their monetization journey with Amazon, and he continues by saying that they're contemplating 50% plus revenue growth for Venmo on top of what they did in 2021. Right now, they say they have 83 million people using Venmo in the United States, and they're going to roll out Venmo with Amazon, Starbucks, and DoorDash, and other high-profile merchants as well that they're probably going to announce later this year. Now, I do want to mention that they still have a PE ratio of 35.8, growing at those low-digit numbers. Maybe it's still expensive. Price to sales ratio of close to 6. Again, it's not extremely cheap right now. By the way, this is on stockcart.io. If you want to join, follow the channel's portfolio. Link will be down in the description below. So it's not because the stock is down 25% or so on these earnings that it turns it automatically into a cheap one. No, it's down a lot because growth is slowing down. Now, if it's true and growth will reaccelerate by the end of the year, then yes, like I said, maybe this is an opportunity. I would like to know what you think about PayPal right now. Do you hold it? Do you plan on buying, on selling? Let me know down in the comments below. And that will be it for this video. If you liked it, consider leaving a thumbs up. If you haven't subscribed to this channel, maybe hit that subscribe button. And as always, guys, take care, stay safe, and see you all in the next video. Bye-bye.